Here's what I want to know, Mark. Where would you turn right now? If there's one market in the world, one asset class that you think offers either safety or the prospect for meaningful capital appreciation over more than the short term, what is it?
I think that because of modern central banking and repeated interventions with monetary policies, in other words, with QE, all around the world by central banks, there is no safe asset anymore. When I grew up in the 50s, it was safe to put your money in the bank on deposit. The yields were low, but it was safe. But nowadays, you don't know what will happen next in terms of purchasing power of money. What we know is that it's going down. And I would say if I had to turn anywhere where, as you say, the opportunity for large capital gains exists and the downside risk is, in my opinion, limited, it would be the mining sector, specifically precious metals, mining companies, in other words, gold shares. And I would also look at, as you just mentioned before, stocks like Freeport, Newmont, American Barrick that have been hammered because of falling commodity prices. Now, commodities may still go down for a while, but I don't think they'll stay down forever.
So, okay, you just kind of answered the question I was going to follow up with, which is, are you effectively calling the bottom of the metal cycle? Doesn't sound like today is necessarily the bottom, but how long is it going to take before we see the prices? I mean, gold has already started to recover a little bit, but the base metals are in a disastrous state, whether it's copper,
yes.
aluminum, nickel, whatever.
I would rather focus on precious metals, gold, silver, platinum, because they do not depend on industrial demand as much as base metals, as industrial commodities. And as I indicated on this program already a year ago, the Chinese economy was decelerating already then. It's just that the fund managers didn't want to accept it. And now it's obvious that the Chinese economy is growing at nowhere near what the Ministry of Truth in China is publishing, but more likely either no growth at all or maybe around 2%, but no more than that. So that has a huge impact on commodity prices, and in turn, it has a huge impact on the economies of all the raw material producers around the world, from Latin America to Australasia, Russia, Middle East, Africa, and so forth. And these countries then, with falling commodity prices, have less money to buy, also less money to buy American goods.
Mark, let me ask you about, we saw the Chinese devaluation, then we saw Vietnam follow and Kazakhstan. I mean, do you expect to see a series of devaluations in Asia? Does that continue?
Yes, these countries just followed the example of what Mr. Draghi and Kuroda tried to achieve with lowering the value of their currencies, which is actually to create a depression in real incomes and a contraction of world GDP in dollar terms and a contraction of world trade in dollar terms, which is, of course, negative for economic growth around the world.
But who's next, Mark? If you had to bet, who's next?
Well, I think the Chinese will probably continue to let the currency float down somewhat. But the safest bet, if you want to bet against the currency, in my opinion, is to short the Hong Kong dollar. Because for sure, the Hong Kong dollar will not be revalued against the US dollar. That is out of the question. But if the Chinese currency, the yuan, continues to weaken, then there will be a lot of pressure in Hong Kong on asset prices, and maybe the government then chooses to rather cushion the decline in asset prices, which would be stocks and real estate, through lifting the peg and devaluing also the Hong Kong dollar. So you have an upside potential without downside risk.
Mark, why is it that I know you're no fan of quantitative easing, but U.S. stocks, you know, Mr. Bernanke and after that Janet Yellen got what they wanted, right? There was a reflation of U.S. asset prices. U.S. stocks until recently were on a 6-year tear. Why is it that we shouldn't expect something similar out of Japan, where stocks have done quite well since they began quantitative easing, or Europe for that matter, where stocks have been outperforming U.S. equities since they began quantitative easing? Why isn't that going to continue?
Because in my humble book of economics, wealth is being created through essentially a mixture of capital spending and land and labor. And if these three production factors are used efficiently, it then creates a prosperous society, as America became prosperous from its humble beginnings in 1800 or thereabouts to the 1960s, 70s. But it's ludicrous to believe that you will create prosperity in a system by printing money. That is economic sophism at its best.
Well, okay, so fine, maybe it all ends in tears, but in the meantime, there was a lot of money to be made in U.S. stocks, no?
Yes, so I didn't say the opposite. But unfortunately, the money that was made in U.S. stocks wasn't distributed evenly. And we have precise statistics, by the way, published by the Federal Reserve, who actually benefited from the stock market boom post-2009. This is not even 1% of the population. It's 0.01%. They took the bulk. And the majority of Americans, roughly 50%, they don't own any shares anyway. And in other countries, 90% of the population do not own any shares. Right. So the printing of money has a very limited impact on creating wealth. And
Mark,
why, may I ask you, why is it that the home ownership rate is at the record low? Please explain to me that.
Well, why was it that the home ownership rate at a record high before the financial crisis? I'm not sure that either.
I have to laugh when someone like you tries to lecture me what creates prosperity.
I'm not at all, Mark. Listen, I'm just as interested in equality as you appear to be. But right now, while I'm sitting here talking to you, being the agent of our viewers, I'm trying to figure out how to make money. That's what they want to know.
Yes, and that's why I told you, if I were you, I would buy mining stocks. I'm not saying they will go up, but I think they'll go down less than a lot of other shares. And by the way, if you ask me about relative value, I think emerging markets are not yet cheap. But I think the return expectation I would have over the next 7 to 10 years by investing in emerging markets would be much higher than, say, in U.S. stocks. Because the U.S. market is overhyped and is expensive in terms of valuations from a historical perspective. Emerging markets are no longer terribly expensive.
Mark, you must then have, over the next 7 to 10 years, at least neutral, if not a fairly positive view of what happens in China's future. I was just going to ask you what you think about President Xi. Can he hold on to power as he's seemingly lost control of everything? He wasn't really able to stamp out corruption. He has no control, obviously, of the markets. If they continue to intervene like this, they won't have any foreign reserves left to hold up their currency. I mean, can he hold on to power as we head into this victory celebration for World War II?
Well, I mean, we have to put the achievements of China and also of President Xi in the context of what China was 20, 30 years ago and what it is today. And it's a remarkable change. Now, will China have a very serious setback And don't forget, the US after 1800 had numerous financial crises and depressions and the Civil War, and went through World War I and through the Depression years and World War II and so forth, and the country continued to grow. I think China is, from a cyclical point of view now, in a very serious downturn, serious. And from a secular point of view, I think there is still a tremendous growth opportunity in China in the long run. But as I said, cyclically, I think they're going to have a tough time.
Mark, we thank you very much. Joining us from Thailand this morning.
Thank you.
One of my faves, Mark FABEr, editor of the Gloom, Boom, and Doom